Hi everyone, thanks for tuning to my channel. This is Sandeep Anand. In the world of information and availability of analysis and reports, today it's no big deal to get any information about any company or any stocks for that matter. You just search in YouTube, you get some 10,000 analysts coming and explaining, different perspectives about different companies. So what is the advantage for shareholders, common retail shareholders? What is that advantage that we have in terms of expecting some returns and creating some alpha in the future? The only advantage, and that has been existing over many multiple decades, and that will continue to exist in the future, foreseeable future. The only advantages are the behavioral aspects and the temperament that we shareholders can have, we investors can have. And the behavioral aspects and temperament forms 80 to 90 percentage of successful investing. And to help with that, I've started some new series around bringing some of the behavioral biases, how that can influence the investing process. Today I'm going to explain one of the interesting bias like that, which is called the anchor bias. So take a look at this and it might be helpful. So here's a presentation. Let me set the expectations right. This is going to be a little dry subject, but I'll try to make it as much informative and understandable. So Wikipedia definition is put there, anchoring or focalism. But I'll make it very simple. It is basically a cognitive bias, which we humans face, which depends heavily on the initial piece of information or data that we get. We human beings tend to stick to that first piece of information or the initial data that we get or the initial price that we see, that sits like an anchor in our minds. And any decision that we make in future will be predicated on that anchor. So whether, if suppose we have to make an estimation, we do the estimation with that first piece of information that we get, as which sits as an anchor. Typical life, real life scenarios are, it's most commonly used by marketing strategists, sales strategists. So it's a real life scenario where most common approach taken by marketing and sales specialists, they utilize this anchor bias as the basis. So they show us all a real estate. For example, if you're going to buy a real estate, the sales team of agency, they show us very highly priced houses initially, much above our budget, to set that anchor so that the expectations are set, and then shows slightly in between range between our budget and that higher price which they want to sell. And we end up almost every time purchasing, choosing a house that is well above our budget. And precisely that's the anchor bias that's set in. Example, we go in search with a budget of say $500,000, and they show us a house of $1 million, and when then the next set of houses they show us like 700K, we might choose thinking that comparatively that anchor bias would fall in, even though exceeding our budget. Then the next real life example is, there is a common adage that goes by, the first impression is the best impression, and that's predominantly predicated on anchor bias. So when we meet someone, the first impressions created form the anchor on which we judge the person in future. It's difficult to change that perception, and which might take a lot of time. And we make adjustments about that impression from starting point reference. So starting point reference always at anchor, then we try to adjust our impressions based on that anchor. Now, anchoring bias can influence everything from real estate pricing in our daily life to car purchases to salary negotiations. Any sort of negotiations, anchoring bias comes into the picture. Now, for us investors, we only want to worry about how it influences in investing. And you could see that one of the most common anchor biases, the 52-week high and low stock prices trading. And its most flawed approach, I would say. Most of the people take a investment decision based on the 52-week high and low price points. And sometimes, not always, the 52-week high is usually considered, mostly people consider the 52-week high as an entry barrier. 52-week low is considered as a suitable bargain, but it need not be true always. And so that's one of the anchor bias. Or if we know that about a stock which is going up drastically from the prices we came to know first time, or we bought the first time, we think multiple times to keep adding to that well performing stock. And that is the anchor bias that keeps playing in. And we'll find it difficult to build more positions, more additions of the same stock when it has gone up already 2 3 times. And precisely that's why most investors end up selling early. Now here is the graph that shows Shopify stock. This is a typical anchor bias that's played in. I'm not saying Shopify's valuation is justified by any means at this point, but this happens since many years. You can see 2015 onwards, how many times Shopify has hit the 52-week high. It had hit for 2015, 16, throughout 17, 18. It's climbing up the wall, and it has been climbing up the stock prices. And an investor who had bought, at 250 would be thinking multiple times to add more positions at 1,000. So this is a typical anchor bias that happens due to the initial price that we came to know about. Stock prices, how to overcome that? Stock prices may not be reflective of the underlying fundamentals most of the time, and sometimes stock prices do not reflect the underlying fundamentals. So a stock hitting 52-week high could be looking at excellent growth many years ahead. So there could be a rationale why it is going up and hitting 52-week highs continuously. Now, the second bias that happens in the investing, with respect to the anchoring biases, selling best performing stocks and retaining the worst performing stocks in the portfolio. It's a very flawed approach taken by most investors, and this is a typical anchor bias that's playing in. Here, investors anchor to the purchase price of the stock. So when we purchase a price at a price and the stock goes down, say 40% from that point, we tend to stick to that, thinking that the price has to come back to the purchase price so that we don't end up in losses. And there is another stock which is a great winner, fundamentally great stock you have, that has, say, doubled or tripled from the purchase price. Most investors end up selling the one that has gone up 2 3 times and retain the one that's loss making, so that we wait for that purchase price to come. This is a flawed approach because there is no fundamental analysis done by investors when they arrive at such decisions. If you really do a fundamental analysis, there could be a reason why the stock that fell 50% or 40%, there is a reason why it fell so. And there could be a reason why the stocks that's going up double, tripled is doing so well fundamentally and business aspect wise. So we have to do the fundamental research. Now here is a famous Peter Lynch story that came in the Forbes 100th anniversary, where Peter Lynch explained. Peter Lynch, for people who are new to the investing world, he had managed the Fidelity Magellan Fund from 1977 and ran it until 1990. And the Magellan Fund averaged around 29.2% annual return. Fidelity is one of the best performing fund in that time. And his book, One Upon Wall Street, is a great read. He has written multiple books. He's one of the legendary investors like Warren Buffett. So here's a story where Peter Lynch says, my biggest mistake was that I always sold stocks way too early. In fact, I got a call from Warren Buffett in 1989. My daughter picks up the phone and says, it's Mr. Buffett on the line. And I thought some of my buddies are kidding me because she was only 6. I pick up the phone and I hear, this is Warren Buffett from Omaha, Nebraska. He talks so fast, and I love your book, One Upon the Wall Street. And Buffett says, I want to use a line from your book in the year-end report. I have to have it. Can I please use it? And Peter Lynch said, sure. What's the line? He was curious, and Buffett said, selling your winners and holding your losers is like cutting the flowers and watering the weeds. And that one line he picked in my whole book and has been my greatest mistake. That is what Peter Lynch has revealed, that his greatest mistake was the same line, that selling winners too early. I visited the first Home Depots ever built. I sold the stock after it tripled. Then it went up another 50-fold. If you are great in the business, you are right 6 times out of 10. But the times you're right, if you make a triple or a 10 bagger, it overcomes your mistakes. So you have to find big winners. I sold way too early on Home Depot. I sold too early on Dunkin' Donuts. Why did I do that? I was dumb. With great companies, the passage of time is a major positive. Forbes 100th anniversary issue. So this is a great read. And for people who have not read Peter Lynch's books, One Upon Wall Street especially, it's a must read to start with. So that is where the buying prices sets as an anchor for most of us common investors. Then the third one is most commonly used as price to earnings multiple, which also is a typical anchor, which could be the most common anchor bias in the investing world. People rely too much on the PE ratios, the price to earning ratios of the company to arrive at valuations, and that too going by purely numerical ratios without doing any fundamental analysis. And they compare historical low PEs, relative valuations. It is just a relative valuation measure, although price to earnings, but we cannot call it a sacrosanct measure of valuation. Now, overcoming these biases, how do we do that? Fundamental analysis and research should be done before buying or selling decisions. Decisions should be taken through rational mind and ensure that anchoring biases don't influence. So Charlie Munger was asked in one of the interviews, what is one reason that he would attribute to all his investing success in the world? And Charlie Munger's response was being rational is the single most factor he would attribute to his success in the investing world. The third point is to overcome bias. A good idea to maintain an investing lessons book. We all can maintain a personal book where we enter all the mistakes we have done in the markets and lessons learned so that we don't repeat such mistakes. And probably create a checklist. We should always have a checklist in investing process and add certain bias related decisions which can influence our decisions. Add those things to the checklist and to ensure that decisions are taken rationally. Now, for more depth analysis and research on anchor biasing and overall in the heuristics and biases world, the anchoring effect was deeply studied by the Nobel Prize winners Daniel Kahneman and Amos Tversky. I mean, Daniel Kahneman won the Nobel Prize, and his partner Amos Tversky. They did a lot of experiments, especially with quantitative focus on estimation tasks, documented well in the much celebrated book "Thinking Fast and Slow" by Daniel Kahneman. So he won Nobel Prizes in prize in economic sciences for his groundbreaking work in psychological insights to economic theory, particularly in the areas of judgment and decision making under uncertainty. So there is a beautiful book out there in Amazon called Judgment Under Uncertainty, Heuristics and Biases. It's a great read, and it covers almost all the biases, and we can typically apply with our rational mind and learn a lot from that. So here is what it says. In many situations, people make mistakes by starting from an initial value that is adjusted to yield the final answer. The initial value or the starting point may be suggested by the formulation of the problem, or it may be the result of partial computation. In either case, the judgments are typically insufficient. That is, different starting point yield different estimates. Very important point, which are always biased towards the initial value. Now, this is a excerpt from the book Judgment Under Uncertainty. It's a paper or book, which journal rather, written by Kahneman, Slovic, and Tversky. So that covers it all in the analysis and understanding of anchoring effect. Take a look at real life scenarios where all this anchoring effect plays a role in our daily life decisions, and we might be surprised with the amount of influence these biases can cause. So thanks for staying with me till this, and I hope it was helpful.